Okay, the question was asked, why do we scale stocks out as they go up? And it's a good question. It's a valid question because, if you sell a quarter in here at the top of the channel and it goes to 9, you've left on the table a quarter of your position, you've left $1 worth of the move. By the same token, if you sell, quarter here, quarter here, quarter here, and it pulls back, breaks the channel line, pops back up, and you sell the balance there, then if you were selling all of your stock here, you've gained all that money. So this is one of the reasons why we can always brag, and I say that tongue in cheek, we can always brag that we top tick the market. And the reason we always top tick the market is because we sell all the way up, and we sell at critical resistance levels that the market recognizes as being a top. And so just by virtue of the fact that we recognize the signals and we're selling part of our position, we'll top tick the market, or within within close to it. For instance, let's say we got into this GME here, pulled back, broke the wedge. We take the trade on here at 7.25, and it starts up in this very strong rising channel that looks like this. And as it goes up, we're in it at say 7.25. We maybe ease some out when it gets up around 8, which is going to be natural resistance for it. Let's say we ease some out on it and sell a quarter of our position. But we know that the support is in here at 7.50. So we sell a quarter position at $8, and sure enough, it pulls back. So we're feeling pretty smart that we top ticked the market. But we still have a quarter of our position left. So our stop is 7.50. It never gets down to that level. And as a matter of fact, it does turn over, and here's another entry level here where it wedges and pops. You could buy it back if you wanted, but it does continue to hold the support, and now it's rising up this channel line. And we just keep riding the channel. It does pull back, but it doesn't really sell off, so we just fan out the channel. It starts to get up around 8.50. We know that's another level of natural resistance, and it pops through it and double tops. We see this double top in here. So we would be selling some of it probably at the 8.50, 8.45, 8.50 area. By the time you put the order in, maybe you caught this. Again, you top tick the market because the pattern shows that you're at the top, and it pulls back, but it holds support. Our support now is down in here at 8.25, 8.20. So we've sold a quarter, we sold another quarter, so we're off half our position. Gets up. Now we have this channel line here, and it's at the top of the channel. And then we also see that we get this big long wick up, and the next candle's red. So we sell another quarter of our position because we know it's going to come down. And in this case, it does hold support for a while, but then it breaks down, pops back up, hits resistance, rolls over, sells. We're out of the balance of our trade. Okay, so we've top ticked the market, but we also eased stock out all the way up. Okay, so the question is, what are we better off to do? Are we better off when the stock hits this level here to sell the whole position and then maybe on the first pullback buy it all back? That's pretty risky. What if it keeps going? You gave back all your profits. But if you sold it all here, then you missed this move. If you were brave enough and you held it the whole way here and sold it at this top part here and sold 100% there, God bless you for doing so, whoever your God may be. But the likelihood of holding this and especially with a chart that pattern looks like this and that, the ability to hold this thing through to that level is, you have to have a lot of fortitude to be able to do that. And the problem is, if you're thinking this is going to 9 and it only goes to 8 and then rolls over, you've missed you've missed the move. You sell it, all your position down here at 750. You missed the move getting some off at 8 and selling the balance at 750 if it breaks down. You sold it all there. So the only reason that we scale out is just so that you're doing a couple of things. You're taking risk off the table, because one of the things that happens with these stocks, and you look at here, if you had bought this here and then kaboom, I mean, these things will come off like a rock sometimes. So if you always need to be selling, and it's my theory, and I've done this for the past 35 years, even if I had tomorrow's newspaper that showed me the stock was up, I'd still sell a piece, because you just never know what's going to happen. You just never know where these things will, what might hit it. Somebody comes out with a research report, a negative research report, somebody, or they take a run at it. Who knows why these stocks sometimes come off the way they do. So you just have to, are you going to maximize the gain? Maybe not. Maybe if you held it, you might get a bigger win. You might not. But we're not in the business of gambling. That's not what we do here. Our business is business. We trade stocks for business. And you have to be prudent in doing so. In running any business, you always have to be prudent. Whereas it's not Vegas. We're not gambling. We're analyzing patterns and taking advantage of those patterns. And in doing so, we need to be taking risk off the table all the time as the market moves up or down, depending if you're short. That's why I'm always scaling out.